today on the Prosperity Nation podcast.
Are you letting your emotions drive your decisions when there's volatility going on in the market or in the economy? Or are there real factors that you should be paying attention to and you do need to act and make changes? And if you don't know, contact us. We'll help you. We'll help you sort through that. Welcome to the Prosperity Nation podcast, the show where we inspire you to live a life you love without money holding you back. I'm Angie Grainger, and this is my co-host, Elise Eropkin.
Hey, Angie.
Hey, Elise. How's it going?
Good. How's
Riggs?
He's good. As always.
Okay, tell me something gritty about him. What has he done recently that's been annoying or fun or cute as heck?
I mean, everything he does is cute, but...
I wish he was the mascot at our last event we did. It would have been so cute to have him there.
He would have gotten so much attention. I think the annoying thing right now he's doing is when we go on walks, he just likes to sit down.
Oh, nice. Does he spread his feet out like flat like that? Is he one of those kind of dogs that like splays out?
This?
Like splays out and lays on his stomach and sticks his arms and legs out? Yeah?
Sometimes. Yeah, he likes to just sit. Just in the middle of the walk.
Just being totally stubborn.
Yep. So that's kind of annoying, especially when I'm in a hurry.
Oh, yeah, that is annoying. Yeah. So, hey, what are we going to talk about today, Elise?
We're going to talk about what to do when the economy tanks, basically.
Is that a prediction?
Well, who knows?
Who knows?
Depends on when you're listening.
That's true.
I'm just kidding.
Yeah, exactly.
I hope it's not a prediction.
That's a good point, because we could be talking about it and things could be great, and then you don't listen to it till the week before everything crashes. Right. So who knows?
Exactly. Yeah. So
I think that's a great topic, because a lot of people either don't know what to do or how to prepare for it, or they don't do what they think they should do. You know, they don't do the thing that seems obvious to do.
Or they freak out and do like the really like reactive thing. That might not be the best thing to do either. It's just so reactive because, panic.
Right. So going back to like 2008, 2009, 2010, when things really did crash, we hit our big recession and the stock market crashed, the real estate crashed, all that stuff. I'll never forget having one of my friends say, yeah, I bought Ford stock when it dropped down to $1.
Oh my gosh.
Right. And like less than a month later, completely paid for his entire kid's college because of that.
That's crazy.
I know, because what were most people doing? They were selling, mm-hmm. and they were too afraid to buy because they're afraid it was going to get worse, right? But that actually is the best time to increase your wealth, is when things crash.
Right. I guess it does. It will eventually go back up.
I hope so.
So far, it always has.
Well, yeah. If the government bailed them out, then it saved them so that they could. I think that's the risk that people don't want to take is, well, what if it keeps going lower? What if it doesn't recover?
What if it doesn't? Well, then we're all just screwed. And so no matter what you do with the money at that point, whether it's in the stock market or not, it doesn't matter.
I guess. But people wanted to pay their mortgage, or they wanted to pay their rent, or they wanted to buy groceries. Right, I guess that's the trade-off. Yeah. So, another thing that I love to tell this story, because years back, I used to run this program called the Youth Business Week. And it was for teenagers, where they would come for a week and we'd run it at the college and we'd raise donations for it and we'd stay in the dorms and the whole thing. And it was a competition. And during that competition, they ran mock businesses. And they actually had their stock prices go up and down based on the decisions they made throughout the week on different quarters of the year. And they would print those in the newspaper, and we'd have the newspaper deliver it, and we'd tape it up on the wall and stuff. So it was really fun. But the last year I did something very different. I went to the college, and I went to the master's program, the students there. I said, do you guys want to bet on these kids' companies? So I literally had it set up like a stock market. But the program showed you in advance the economic indicators. So you could see what was potentially coming as far as sales growth, or if the economy was contracting. how it might affect it. And the kids had to take that into consideration by how much inventory or how many salespeople they had to hire, etc. The companies would get stuck, if the economy crashed, but they just hired a bunch of salespeople, but now nobody's buying it, then they'd have to lay it down, their stock price will go down, etc. So I had the college students bet on them. This was the biggest life lesson that I hope they all learned. I hope everybody in that classroom learned this because it was brilliant. The economic factors were showing that the economy was about to dive. The indicators, right? They had the predictive index. And every single student except one sold all of their stock. And one sold it the quarter before, and then when it crashed, bought it all.
Wow.
His net worth, by doing that, was almost 10 times the value of everybody else's in the class, just because of that one move of selling when it's low and buying when it's high. And he did it the opposite, which is selling when it was high and buying when it was low, because he was paying attention to the future, the economic signs of what was coming.
That's what they teach you in most, classes on this stuff, or in the Series 65. It's like,
but people don't do it.
People don't do it. It's
Why?
a lot. It's a lot to have to follow, I think.
Right.
I don't know. For the average person, it's like a lot of that's just, you don't understand what a lot of it is anyway. So then trying to follow it and know what that means and what things mean and know when things are going to start to go down so you can sell when it's high. And what if it goes higher and you don't want to sell too soon? There's so many things.
I know, but you know what? I don't think it matters. I don't think it matters. Yeah, because it's all based on emotions. It's not based on logic.
What, like buying it low and stuff, or
because people know they should do that, but then they don't do it because why? They're afraid.
They're afraid,
or they get caught up in the excitement of the hype of something going, and they don't want to miss out.
Or they get cocky.
Yeah.
And they think it's going to keep going up or something, It's like when you're gambling, you're like, you're up, and you're like, just one more, and then you lose it all.
Yeah.
Because you waited that second too long.
Well, and you're watching, right now, there's a particular stock that's just going down really fast right now, and it's like you're looking at that, and you think about it and go, well, I should buy when it's low, but is it all the way low? Is it going to go more? If I put $10,000 in it now, is it still going to go down to $1,000? Am I still going to lose? What if it never comes up? What if they go out of business?
People wait because they think it could get better than what it currently is. And then they wait and don't pull the trigger. And then they are like, oh, I should have done it then when I had the chance.
Yeah, exactly. So it's emotions.
It's true. It's almost like, I forgot what I was doing, but it's almost like you're dubbing in information that isn't actually there.
Like how?
Like you're looking at the numbers and you're seeing the numbers. And I know a lot of these apps and stuff like Robinhood or whatever, they tell you the lows and the highs. And so you actually have data to compare what today's value is versus the lowest. So it's like you can realistically use historical information to see if it's going to realistically go lower, but you're adding extra variables into those numbers when you should just be using the actual stats. You're adding the emotion, the feeling it's going to get better or worse, or all this other stuff. So you're putting in extra things that don't actually exist.
Well, yeah, because you can't predict based on what happened in the past. You can't use what happened in the past to determine what's going to happen. It actually has nothing to do with it. If you think about it, it's like rolling the dice on the roulette table or on the craps table or something. It doesn't matter how many times you just rolled it. Doesn't matter how many times you crapped out or you got the sevens or the ones or the whatevers, right? It has nothing to do with the roll you're going to roll right now. So you could say, yes, I won 28 times in a row, and that next chance that you roll has nothing to do with those. And so, but emotionally, we don't want to think that way, and we don't want to face that way. We look at look at what a performance is and we think, oh yeah, that performance is good, I'll go ahead, or that's bad, I'm not going to.
I think it's a lot. Yeah, it is a lot of feeling. Or maybe you just like that company.
You know, like the gambling.
You don't? I don't know. Some people do. But I still think that past performance can serve as like, I'm not like, I don't know. Obviously you can't use it to know exactly what's going to happen. But you can say, well, if the lowest was this and the current value is this, it could theoretically go lower. It hasn't gone much lower, so maybe this is the low. Then that's when I'll buy now, instead of like the lowest is like $30 lower still, and you're like, I don't know.
I know. I know, but we have to put all those disclosures and disclaimers about how past performance does not predict, current performance. I know. It's like we have to always say that just from regulatory perspectives because it isn't. But emotionally, there might be. And, we talk about trend lines all the time. Even looking at the stock market, you're looking at a line, you're looking at a trend, which means you're looking at all the historical data up till now, because those trend lines don't predict into the future. They go till today or to this moment.
No, and there's also other variables, kind of like you were saying in the school example of like, what is the company doing? Are they making changes? Has there been blah, blah? So many different factors that could go either way. Even like around election time, that could affect the stock market no matter if there's been no change, just based on who's going to become president or not. Or, so there's so many other factors. And I think the problem is that's a lot for people to keep up with to to figure out when to buy or sell, and then how do you do it?
Well, it's just like any decision in life, too. If you don't know the factors about making a decision, you only have left your emotions. It's kind of just always comes down to that. So how much data do you need? How much information do you need to feel comfortable making a decision that's not an emotional decision? And do you have the time or the know-how to do that?
Yeah.
And so you ask your friends, what did you do? Right?
Yeah.
What would you do if you saw that the stock market was going down? Would you cash out? Would you wait? Would you hold? What would you do?
I think for me, I am more of the long-term play. I just kind of leave it. And I assume the market's just going to eventually correct itself. I'm not like one of those people who constantly is monitoring and buying, selling, buying, selling, buying, selling. So I think I would do nothing. But that's just me,
Well, we're advisors too, so we're helping our clients navigate these things. And I think you're right. It's like if you are day trading and you're trying to time the market to try and get good value and, buy low and sell high, the only thing with that is you have to be right twice. You have to be right when you sell it and when you buy it, and when you buy it and when you sell it. And that is harder.
It decreases your odds of being right.
Exactly. And it is true. It's proven, through all the research and the historical data that we do have now, that an asset allocation strategy being diversified across lots of different areas, that over time, not trying to guess the market and day trading and selling and buying constantly actually does outperform when you have an asset allocation, a long-term diversified strategy. But with that being said, you can't ignore major factors in that, and that's going back to 2008, 2009, 2010. It crashed. The situations were unusual, and other factors did need to be considered in that buy and hold or long-term strategy.
Yeah, and I think that's big because if it was just like the stock market going down, you're like, okay, it'll fix itself next week, tomorrow, whatever. But if there's a lot of other external, like you were saying, things happening in the world, maybe there's another war, I don't know, whatever it might be, that could be a more long-term thing that you might want to make a decision to do something on.
Well, if your stock portfolio drops 30% like it did or more, which it did back then you have to realize that could be 10 years to get that back again. Yes, you will probably get it back, but that was 10 years. And it was 10 years of gains that you lost and 10 years to recover it. So you have to understand and know, like, if you can't handle that kind of volatility, then you might be invested in the wrong thing for the time frame that you're trying to fund.
Yeah, I was thinking that too. If it also depends on your risk tolerance.
And risk tolerance plays in with the timing of when you need that money.
Yep.
You know,
Because that's why
factor.
for me, I would, like I said, I almost fell. I was trying to adjust myself and then my arm.
I'll just throw you out the window,
I'm
Elise.
just going to fall down. I'm like relatively risky because I'm still pretty young. And so I'm not as concerned about needing a bunch of money right now or in the next few years. So that's why back to your original question, that's why I just kind of let it sit and just kind of correct itself and then go back up. But if I were older, I think, and I actually needed to have a certain return, then I would probably rethink it, pull some money out, put in more fixed income. I don't know, something that might be a little more conservative if I thought something major was going to happen.
Yeah, and the time to do that is before the economic indicators happen. Like, those are the conversations you should be having with your advisor all year long, not just because something is in the news that's concerning.
Right.
Might be too late at that point if you haven't already handled it.
That's true. It's hard
but
to
if
tell.
you, even young though, if you were trying to save up to buy a house, or if you had kids and you wanted to go to college, then that risk on that money is going to be different than the risk on the money that is for the 20 or 30 or 40 year retirement goal.
That's true.
And so the risk depends on the timeline. If you think about it, that's really one of the most important factors of when do you need that money.
Yeah. I know for me, I think that's why I have money in all different places.
Yeah.
Because it's like, some is it for this, some is my long term, some is my medium term.
Yeah, because it goes back to our whole philosophy, flourishing personally and financially. That means that you need to know when you need that money. To know when, you need to know what. What do you want money for?
What do you want it for?
Like, we haven't said that before.
No.
Right?
Never. Nothing that's ever come up.
Yeah, exactly. Because that's it. The money is just it's just there for you to accomplish something. So if you don't know what that is, then how will you even know what your risk tolerance is? How will you know even what your time frame is?
Because you don't know how much you even need.
You don't know how much you need. Exactly.
For anything. I think that's key. You joked, we say this all the time, but it's hard to tell people what to do with their money if they don't even know what they want it for.
Exactly. Exactly. Well, because we work so much on income planning and goal funding, we spend so much time with our clients to figure out what do you want money for. Then when we monitor the economic indicators that are happening out there, it's a lot easier for us as advisors to say, okay, these economic indicators are way outside the norm. We need to do something to protect the client's goals that need to be funded. Or say, that's fine, the economy can go up and down, the stock market can go up and down, because we know that we have that earmarked for something that's going to outlast the volatility that's happening.
Right.
But if you don't know, you don't spend the time of exactly what do you want this money for, the clients get stressed out too, because they hear all the news and they see things too, and they don't know what they should do, and then they want to have those conversations with us, and if we don't know, how are we going to guide them?
Or I think it's important also to communicate that we're aware.
Yeah, exactly. We're being proactive. You don't have to listen to the news.
You don't have to worry.
We got your back on that, unfortunately. We have to do that.
Yeah, and I think that's important for any advisor, when stuff happens, or if there's any major things happening in the market or whatever, so just at least communicate that.
Right. Exactly. Well, I just wanted to bring up I'm glad we had this topic. I think it was a good topic to say, are you letting your emotions drive your decisions when there's volatility going on in the market or in the economy? Or are there real factors that you should be paying attention to and you do need to act to make changes? And if you don't know, contact us. We'll help you. We'll help you sort through that, because it is not an easy decisions that you have to make when there's volatility in the market and you don't have that certainty. But we're here. We're here to help.
Yeah, definitely. If you do want to contact us, you can shoot us an email at stories@prosperitynation.com. You can also like and subscribe to our podcast and follow us on social media.
Awesome. Well, we look forward to hearing from you. See you next time.
All right, see ya.
Thanks for joining us today. Like and subscribe to videos from us on YouTube. Follow us online for the latest episodes, updates, and more. And invite others to join us at prosperitynation.com. That's it for now. We'll see you next time on the Prosperity Nation podcast.